we use an investment philosophy we call the 5 R's. Okay? For those of you who remember it. Most money is to be made off of other people's mistakes. A property is failing, somebody made a mistake. So we go in there and we fix it up, we buy it, we recapitalize it, put the money into it that's needed to go into it, rehab it, meaning fix all the problems, reposition it, which allows us to give it a new personality, a new feeling, and really a good marketing plan to fill the property up. Then we refinance it, take our cash out, which is tax-free, and then repeat that process. So we hold on to the properties long term, and there's reason for that, which I'll get to here in a little bit. I also threw on here a bunch of commercial properties that I've done. The economics are the same no matter what kind of income producing properties you buy. You've got to remember that when you're buying real estate, I'll tell you that in a second. Now I throw in the disclaimer. It's not a liquid investment, so your money is tied up. There is market risk. We're only giving this information. We're not pitching anything to you. We're not trying to sell you anything. So you're only here for the drawing. It doesn't really matter. Even though we have past performance and we've got a good track record, it's no guarantee of success. And if you want to get any information about any potential investments, you talk to Jeremy. And there's a whole process to do that. It really is, money does grow on trees. I'll prove it to you, okay? You just need to know how to harvest it and make it happen. Income producing properties are only worth the income they produce. And you need to remember that. When you're buying a property, you're only buying a stream of cash flows. That's all you're buying. You're not living in it, right? You're not doing it just because you want to enjoy the property. It's not your vacation home. You want somebody to pay you money for living in that property. So it doesn't really matter if you're in a quality property or a D quality property. Quite honestly, the D quality property will have better, higher returns because of higher risk. But it's only worth the income it produces. So if you can increase the income on those properties, they're worth more. Okay, we'll show you how that works. But before we do that, let's talk about the why. Okay? I was supposed to take that part of it off there. Almost tax-free passive income. Why do you want to invest? John, why do you invest?
Because I'm lazy. You do all the work.
Because you're lazy and I do all the work. I'm lazy and I have other people do the work. We're in the same boat. But really it's for financial freedom. I think that if you don't, freedom is having options. Somebody who's in jail has no options. They're told exactly what to do, what to eat, things like that. And it's possible for you to be in economic jail. Somebody that's living paycheck to paycheck, which there's no shame in that. But what we want to do is get you out of that position, which is why we invest in real estate. That's why you're all doing it. For those of you who invest, you already know that. You want to grow your money and grow those returns so that you can tell the boss to take a hike. Okay?
Which I did at the first of the year. How about that?
Congratulations. And more importantly, you make money when you buy real estate. That's the nice part about it. You can look at it and say, this is how we're going to make money. We can have a plan for it beforehand. So it's not like a stock or gold or precious metal. You're not buying it and hope it goes up. You're not speculating. We go in there knowing what we're going to do based on actual factual data on how we're going to increase the value of that property. They are still projections, but it is still the ideal investment. Most of you have heard all this, so I apologize. These properties, they produce an income for us. You get an income if you buy gold or stocks or anything else? No. Depreciation allows us to write off most of that income so that it's tax-free. Can you do that in any other investment? No, absolutely not. Equity capture. Can you buy gold less than spot price? Can you buy a stock less than its value? No, you can't. Appreciation. Now, the other things have appreciation also, but we can have forced appreciation by raising rents and lowering expenses. We'll go in more detail in a second. And the other is another beautiful thing, leverage. Speaking of leverage, Paul Peebles just walked in and snuck in the back of the room. He's our king of leverage. Wave, Paul. Everybody, if you don't know Paul, yeah, there you go. Old Capital Lending, and he's having an event on October 5th. October 5th, the big event to come learn and participate in that. It's an all-day event. Everybody should go. You can look at oldcapital.com and find out about that. But bottom line, I'm pushing him so much because he handles all the loans for us, okay, and does a great job at it. Never failed us. One of the other things I like about real estate is you can control it. Okay, I remember buying my first rental house, and I basically said, you know what? If something happens to this, I can still come out there and I can kick it, I can hit it, I can do whatever I want with it. Whereas if I have a stock, I have a blip on a screen, I can't do anything about it. I can always do something with the real estate because I control it. It's in my own hands. That's real important. Here's the whole secret formula. Okay, everybody ready for this? Okay, this is tough stuff here. Okay, income, your operating income, the money you receive, minus the amount you have to pay out for that, not including debt service, just your operating income, equals your net operating income. Okay, this is high math here, so try and keep up. Okay. Operating income minus operating expenses equals net operating income. Now you divide that by what's called a cap rate, a capitalization rate. And cap rates will vary depending on the type of property, where we are in the market cycle, etc. But divide that by the cap rate and you come up with your value. Now, I used to teach $1 equals 12, right? You all remember that? Well, that was at an 8.25 cap rate. For every $1 in net operating income, it creates $14 in value. Okay? Following that, right? Not losing anybody here. Okay? Let's use an actual example from that. Okay. Let's just say we have a property that has an income of $600,000, an expense of $300,000, giving net operating income of $300,000. Okay, if you need to pull out a calculator, feel free to do so. That was a joke. Thank you. Divide that by the 7% cap rate means that property is worth $4,285,000. Simple, right? Well, we go in there knowing that we can do certain things to the property and increase the income. If we just increase the income by 10%, okay, to $660,000, our expenses, let's just assume they're staying the same, so our net operating income went up $60,000. $1 equals how much? $14.28. So that $60,000 times 14 just increased the value of the property by $857,000. Poof, magic. That's a 10% increase in your income. That's all you did. Okay? Do you think that you can do something to create some type of value to increase rents by 10%? Relatively simple, right? Even in a market like this, though, rents are going up as much as 10, 12% a year anyway, without doing anything. So even crappy investors can get an increase in income because the market's going up. But we go in there knowing that we're going to increase that. So we just increase the value $857,000. Poof. Great. Yes, sir.
I don't understand cap rate.
Okay, cap rate, just think about it as a return on investment if you pay cash. And the cap rate will vary depending on the type of property, et cetera. It's one of those things that's just mysteries of the universe, okay? It's always going to vary depending on what it is. But all it is a way for you to compare everything apples to apples.
So you're saying in this instance, you're expecting 7% return on investment?
If you paid cash for that product, if you paid $4,285,000, then your return at 7% would be $300,000. Okay? Now, all we did was raise the rents and created $857,000 in value. Okay. It doesn't get any easier than that, does it? Holy crap. Okay. Now, we're putting money into the property, we're fixing it up, we're operating it better, we raise the rents. Well, let's just say we can lower the expenses by $50,000. Again, now the net operating income goes to $410,000. Now the value of the property is $5.8 million. Now we've created $1.5 million. Poof. Just created it. Okay? Wow. Poof. We just created $1.5 million. What do you want me to make the Empire State Building disappear? Okay. This is incredible. Okay. Yes, sir.
From Ken about proof that there's nothing to do.
There's nothing to do. It just happens. That's what Pat and Michael and Vicki and Ken do. Okay. My part of it is I come up with the business plan for it, and then they tell me whether I'm right or wrong, and that they can actually do that. So it is a team effort. Now, okay, we created $1.5 million. Oh, so what does that mean to me? Okay. Let's just say we paid $4.3 million for it. It was only worth $4,285,000, but who cares? We're going to pay $4.3 million for it. Okay? We already know that our plan is to make it worth 5.8. Right? We're going to have to put some money in capital expenditure, some improvements. We need to make improvements to the property. Let's just budget $300,000 for that. We can roll a lot of that into the loan, right, Paul? Okay. So our all-in, our total investment is $4.6 million. But then you think, I don't have $4.6 million, right? Well, let's assume that we put 30% down, okay, which is a pretty high down payment. $1,380,000. Now, the very first deal I did, I had to raise, I don't know if it was $1 million or 1.1. Let's just say it's $1 million. And I signed the contract and I bought that and I said, holy crap, where am I going to come up with $1 million? But all I said is, wait a minute, I just have to find 10 people that want to make money with me, and now I buy this. So that's all it is. $1,380,000 is not a lot of money. But bottom line, let's keep going with it. $1,380,000 is what we put down. Now we go ahead and do this. Let's assume this takes 1 year, 2 years, 3 years. Okay? We put $1.4 million down, but we increase the value by $1.6 million almost. Okay? We sell the property. Okay? It's worth 5.8. Let's sell it for $5,857,443. Okay, it's going to cost money to sell it, so we're going to hire one of those brokers, go out there, sell it, get the best price for it, and we're going to pay them for it. We're going to pay closing costs, etc. We're going to pay off the loan that we got. Now, 3.2. Remember, the purchase price was 4.6 minus the cash that we put down, so we got a loan for the rest of it of $3,220,000. Well, we sell it for 5.8, pay closing costs, pay off the loan, and we have net proceeds of $2.4 million. Okay, so for those people that decided to invest $1,380,000, 3 years later, they're turning around and getting 2.4. Yay. Okay, magic. Okay, poof, out of thin air, right? Okay, so really had a gain of $1 million, just made 74% on our money just from those. That didn't include cash flow, that didn't include anything else. That is just operating the property more efficiently so we know what we're doing to raise the rents, and then we know what we're doing to lower the expenses. And poof, made $1 million. Okay? That's exciting. I love that. It's like magic. Create $1 million. Hey, who wants to create $1 million? Okay? So that's 74% gain on your money in 3 years just by doing simple math. Okay? You do have a little bit of division in there. Okay? But other than that, it's plus and minus. Okay? Very, very simple economics. Okay, first, any questions on the economics of that? Okay, either I am great at explaining or you can't hear me, one or the other. I'm going to go ahead and go with the value was your NOI, net operating income. Your net operating income divided by the cap rate comes up with your value. Okay? He was out in the hall, yeah. Okay, now that's what we call a value play. We're creating value. We don't even really care about cash flow because we want the big 74% bump in our equity. Okay, so we don't care about the cash flow. All we care about is creating a lot of value, right? Well, what about a yield deal? What does something like that look like? Be sure to visit us at darwingerman.com. There you can register for all of our information and see all of the videos. And make sure to like us on Facebook and subscribe to our YouTube channel for more videos.